Gold and silver prices surge as war risk builds. Gold and silver are surging, but this is not a market celebration. This is a warning signal, one that most investors will understand too late. A single waterway, smaller than most people can find on a map, is quietly holding the entire global economy hostage. And right now, the tension around it is reaching a point that precious metal markets have not seen in decades. The question is not whether something is coming. The question is, are you positioned before the window closes forever? Welcome to Financial Crisis. Explained, the one place on the internet where we don't guess, we decode. Now, before we go any further, if you found this channel today, consider it less of a coincidence and more of a timely arrival. And to our seasoned viewers, those of you who've lived through oil shocks, market crashes, and economic winters that younger generations have only read about in textbooks, we see you. And we ask you, the way one asks a wise elder for guidance, please hit that subscribe button. Not for us, but so that this kind of serious, no-nonsense analysis finds its way to the people who need it most. One click from you could protect someone else's retirement. Now, before we begin, drop a comment below and tell us what city, what country, and what date are you watching this from? Because this story is unfolding in real time, and where you are in the world matters more than you think. Let's begin. Gold and silver do not lie. They do not respond to rumors the way social media does. They do not react to headlines the way nervous retail traders do, and they certainly do not move in silence, without reason, the way they have been moving in recent weeks. When gold climbs past significant price thresholds, and silver follows with a kind of quiet, deliberate momentum that experienced market watchers recognize immediately, something serious is being communicated, not by analysts, not by television commentators, not by government press releases, by the market itself. And right now, the market is speaking in a language that most people have not yet learned to read. To understand what is truly happening beneath these price movements, one must first understand a concept that separates serious investors from casual observers. It is called the fear premium. A fear premium is not panic. It is not a sudden emotional reaction to a breaking news alert. It is something far more calculated, far more deliberate, and far more dangerous to ignore. It is the price that institutional investors, the large funds, the sovereign wealth managers, the quietly powerful financial entities that move billions without press conferences, are willing to pay in advance for protection against a risk that has not yet fully materialized. When these entities begin accumulating gold and silver at elevated prices, they are not reacting to today's headlines. They are responding to tomorrow's probability. And that distinction changes everything. Consider the current numbers with the seriousness they deserve. Gold has been trading at levels that would have seemed extraordinary just 2 years ago. Silver has been holding in territory that signals genuine industrial and monetary demand, not speculative noise. Platinum and palladium, often overlooked by casual investors, have been sending their own quiet signals of stress within global supply chains and manufacturing networks. These are not the prices of a market that is sleeping. These are not the numbers of an asset class that has missed the signal. These prices represent a market that has been awake for some time now, accumulating risk premium, layer by layer, week by week, building a foundation beneath these metals that did not exist 18 months ago. So when the average viewer watches a news segment and asks, if war risk is so serious, why haven't gold and silver gone vertical overnight? The answer is both simple and deeply instructive. Because the move already began, most people simply were not watching when it did. This is the fundamental error that costs ordinary investors and young entrepreneurs the most. Not bad timing, not wrong analysis, but the assumption that markets wait for public confirmation before they begin to move. They do not. By the time a geopolitical crisis appears on the front page of every major financial newspaper, by the time the television anchors are using urgent language and displaying dramatic price charts, the institutional positioning has already occurred. The fear premium has already been built into the price, and the window for maximum strategic advantage has already begun to close. What the market is showing right now, through the behavior of gold and silver, is that sophisticated capital began moving quietly and deliberately well before the current wave of public attention arrived. That raises the most important question of this entire analysis. If the fear premium is already embedded in current prices, if institutional money has already begun its repositioning, then what exactly are gold and silver still pricing in? What risk remains ahead that has not yet been fully absorbed by the market? What shock, what event, what escalation are these metals still preparing for? Because here is what decades of market history confirms without exception. When gold and silver build slowly, steadily, deliberately, without a clean single catalyst to point to, it does not mean the danger has passed. It means the danger is still arriving. And the most consequential part of this story has not yet been written. Draw a line on a map. Make it small, make it narrow. Give it shores on both sides close enough that a careful eye can see across on a clear day. Now imagine that through this single, unremarkable-looking strip of water flows the economic oxygen of the entire modern world. Not some of it, not a portion of it. A quarter of every barrel of oil traded by sea on this planet passes through this one corridor. Approximately 1/5 of total global petroleum consumption moves through it daily. And nearly 1/5 of all liquefied natural gas, the fuel that heats homes, powers factories, and keeps industrial supply chains breathing across Europe and Asia, travels through this same narrow passage. This is the Strait of Hormuz. And right now, it is sitting at the center of a geopolitical pressure system that precious metal markets are watching with an intensity that should concern every serious investor and every young entrepreneur building a business in today's economic environment. To understand why this waterway matters so deeply to gold and silver, one must first understand the chain of consequences that a single disruption event would trigger. It does not begin with panic. It begins with a number. The moment credible military threat, or actual conflict, interrupts the flow of energy through the Strait of Hormuz, oil prices do not gradually adjust. They do not politely recalibrate over several trading sessions. They spike, hard, fast, and with a velocity that sends immediate shockwaves through every connected market on Earth. Rising oil prices are not simply an inconvenience at the fuel pump. They are an inflation mechanism that penetrates every layer of a modern economy. Transportation costs rise, manufacturing input costs rise, food distribution costs rise, the price of producing, packaging, and delivering nearly every physical good on the planet rises simultaneously. And when inflation accelerates under geopolitical pressure rather than organic economic growth, central banks face an impossible choice: raise interest rates and strangle an already fragile global economy, or hold rates steady and watch purchasing power erode in real time. Either path leads serious capital toward one destination: gold, silver, hard assets that governments cannot print. This is not theory. This is not speculation constructed for the purpose of dramatic storytelling. This is the documented historical pattern that has repeated itself with remarkable consistency across every major Middle Eastern conflict of the past 5 decades. When the energy supply chain faces genuine existential pressure, when the world's most critical maritime corridor becomes a contested zone rather than a neutral passage, precious metals do not merely rise as a reaction. They rise as a recalibration, a fundamental repricing of what safety costs in a world where the assumptions underlying global trade have been shattered. Now consider the specific actors currently positioned around this corridor. The United States military presence in the region has been reinforced. Israel's strategic calculus has shifted in ways that regional analysts describe as historically unprecedented. And Iran, the nation whose coastline forms the northern edge of the Strait of Hormuz, has both the motivation and the demonstrated capability to transform this waterway from an open channel into a pressure point of extraordinary economic consequence. This is not a distant hypothetical being discussed in academic journals. This is an active, developing situation that energy markets, shipping insurance underwriters, and sovereign wealth funds are already factoring into their forward positioning. The question precious metal investors must ask is not whether the Strait of Hormuz matters. The question is how much of its risk has already been priced, and how much is still waiting to land. Because history does not remember the investors who waited for certainty. It remembers the ones who understood probability, who read the signal before it became a headline, who recognized that the world's most important waterway was never truly just about oil. It was always about everything connected to oil. And in today's world, that means everything. The market already knows the Strait of Hormuz is under pressure. What it does not yet fully know is what happens next. And that uncertainty is exactly where part 3 begins. There is a moment in every major financial shift that separates the prepared from the devastated. It is not the moment the crisis hits. It is not the moment the headlines scream. It is not even the moment the central banks hold emergency meetings behind closed doors. It is the moment just before all of that. The quiet moment, the unremarkable Tuesday afternoon, the trading session that looked almost ordinary to everyone who wasn't paying close enough attention. That moment is usually already behind us. To navigate what is coming, one must first perform an honest and disciplined exercise, not an optimistic one, not a fearful one, a precise one. The exercise is this: draw a clear and unmovable line between 2 categories of information, what the market already knows and what the market does not yet fully understand. Because these 2 categories do not carry equal weight, they do not present equal opportunity, and they do not demand equal urgency. What the market already knows has already been absorbed into price. It has already been debated in institutional research reports. It has already been factored into the forward positioning of funds managing hundreds of billions of dollars across multiple asset classes. Acting on what the market already knows is not strategy. It is simply arriving late to a dinner party where the best seats were taken hours ago. So what does the market already know? It knows that geopolitical tension in the Middle East is elevated. It knows that the Strait of Hormuz represents a vulnerability in global energy supply chains. It knows that gold and silver carry historical credibility as stores of value during periods of monetary and political instability. It knows that inflation, despite the carefully managed language of central bank communications, has not been fully defeated. It knows that sovereign debt levels across major economies have reached territories that previous generations of economists would have described as structurally dangerous. The market knows all of this, and it has priced all of this. Every institutional investor with a Bloomberg terminal and a risk management department has run these scenarios. Every sovereign wealth fund worth its mandate has adjusted its commodity exposure accordingly. Every serious portfolio manager operating at scale has already had the internal conversation about precious metals allocation. This is why gold did not explode overnight when the latest headlines broke. Not because the market missed the signal, because the market had already been reading it for months. But here is where the analysis becomes genuinely critical. Here is where the line between what is known and what is not known reveals its most consequential gap. What the market does not yet fully understand is the cascade. Individual risks, rising oil prices, military escalation, inflation pressure, currency devaluation are all understood in isolation. Institutional models have stress-tested each of these scenarios independently. Risk managers have built frameworks around each individual variable. What those models struggle to price accurately is the moment these variables stop behaving independently. The moment a military escalation in the Strait of Hormuz triggers an oil spike that simultaneously accelerates inflation, that forces a central bank policy reversal, that destabilizes an already fragile sovereign debt structure, that triggers a currency crisis in an emerging market economy, that sends a wave of capital flight into hard assets simultaneously across multiple continents. That sequence, that cascade, is not yet priced. And this is precisely where platinum and palladium enter the conversation, not as footnotes, but as evidence. These metals are deeply embedded in industrial supply chains. Their pricing reflects real-world manufacturing stress, automotive sector uncertainty, and the kind of structural economic pressure that does not appear in geopolitical news alerts, but reveals itself quietly in commodity markets to those disciplined enough to look. When platinum and palladium move in alignment with gold and silver under geopolitical pressure, it is not coincidence, it is confirmation. Confirmation that the stress being signaled is not limited to investor sentiment, it is structural. Now consider the retail investor. Consider the young entrepreneur watching these markets with genuine concern but incomplete analytical tools. Their most common question in moments like this is painfully revealing. Why didn't gold and silver explode the moment the news broke? This question, asked with complete sincerity, exposes the single most dangerous gap in popular financial literacy. The assumption that markets move after confirmation. They do not. Markets move on probability. And by the time confirmation arrives, by the time the event is undeniable, by the time every financial news network on Earth is running the same urgent banner across the bottom of the screen, the probability has already become reality, and reality is always more expensive than preparation. The market already knows the fire is close. What it hasn't fully priced is the moment the wind changes direction. And when that moment arrives, it will not announce itself. It never does. The window that still exists today may not exist by the time Part 4 begins to feel urgent. But for those paying attention right now, it is still open. Every crisis in financial history has contained within it a window, not a door, not a wide open highway, not a comfortable, well-lit corridor with plenty of time to think, consult, deliberate, and decide at leisure. A window, narrow, unannounced, and closing at a speed that only becomes obvious after it is shut. The investors who built generational wealth during the oil shocks of the 1970s, during the currency crises of the 1990s, during the deliberate and methodical collapse of 2008, did not do so because they were smarter than everyone else in the room. They did so because they recognized the window while it was still open, and they moved. That window is open right now. But before any serious investor, any ambitious young entrepreneur, any business decision maker reading the current environment with genuine strategic intent acts on that statement, they must first perform the most important exercise in economic self-awareness. They must ask themselves one brutally honest question. What am I actually trying to protect? Not what they hope to gain. Not what return they are targeting, not what their colleague mentioned at a dinner last week, or what a social media financial personality suggested in a 3-minute video. What they are trying to protect. Because the strategic logic of this moment is not built on opportunity alone. It is built on preservation. And preservation In an environment where geopolitical risk is structural, where inflation pressure remains embedded, where energy supply chains face genuine existential vulnerability, requires a fundamentally different decision framework than the one most investors were taught during a decade of artificially low interest rates and unconditional market confidence. There are precisely three strategic positions available to serious decision makers in this environment. The first is the hedge. This is not a passive position. This is not simply buying gold and silver and placing them in a drawer while hoping for the best. A genuine hedge in this environment means deliberately allocating a calculated percentage of liquid capital into hard assets, precious metals, commodity-linked instruments, inflation-protected structures, as a direct counterweight to the paper-denominated risk sitting in the rest of the portfolio. The hedge does not require certainty about what happens next. It requires only the intellectual honesty to acknowledge that something significant is already happening. The second position is the strategic weight. This position is not weakness. It is not indecision dressed in the language of patience. When executed with discipline and backed by clear, predefined trigger points, specific price levels, specific geopolitical developments, specific central bank signals, the strategic weight is a legitimate and powerful tool. But it carries one condition that must be understood without compromise. The strategic weight only retains its value as long as the window remains open. The moment the cascade begins, the moment the individual risk variables stop behaving independently and begin amplifying each other simultaneously, the strategic weight transforms from a position of disciplined patience into a position of paralyzing hesitation. And hesitation, in a closing window, is indistinguishable from inaction. The third position is capital reallocation. This is the most demanding of the three. It requires the most honest self-assessment. It demands a willingness to look at existing portfolio structures, existing business capital allocation, existing assumptions about which asset classes carry safety and which carry hidden risk, and redesign them with clear eyes. For young entrepreneurs specifically, this moment carries a dimension that pure investors do not face with the same urgency. Business capital is not just investment capital, it is operational oxygen. When inflation accelerates under geopolitical pressure, when supply chain costs rise across multiple input categories simultaneously, when currency purchasing power erodes faster than revenue growth can compensate, a business that has not protected its capital structure does not simply underperform. It suffocates, quietly, gradually, and then all at once. This is why the behavior of gold and silver in this moment deserves attention that goes far beyond the question of whether metals prices will be higher or lower next quarter. These metals are not merely investment instruments performing well in a risk-off environment. They are indicators. They are the market's most honest, most historically consistent, most institutionally respected mechanism for communicating one singular message to anyone disciplined enough to receive it. The message is not complicated. It is not encoded in technical jargon or buried in footnotes of research reports, available only to institutional subscribers. It is direct, it is clear, and it has been delivered with remarkable consistency across centuries of economic history. Something is shifting at a structural level. Not cyclically, not temporarily, not in a way that the next quarter's earnings report or the next central bank press conference will resolve cleanly and completely, at a level that rewards preparation and penalizes assumption. The Strait of Hormuz remains under pressure. Military positioning in the region has not de-escalated. Inflation has not been defeated. It has been managed into temporary patience. Sovereign debt across major economies continues to accumulate at speeds that compound risk silently and invisibly until they don't. And gold and silver continue to build. Not explosively, not in the vertical panic move that casual observers expected and then questioned when it didn't arrive on their timeline, but deliberately, structurally, with the quiet, unmistakable confidence of a market that understands what most people are still waiting to be told. The window that exists today will not exist indefinitely. It never does. History does not offer the same opportunity twice at the same price. And the most expensive lesson any investor, any entrepreneur, any serious decision maker can learn is the one that arrives after the window has already closed. The question this video began with was simple. Gold and silver prices are surging as war risk builds. The question this video ends with is the only one that matters now. Are you positioned before the window closes, or are you still waiting for confirmation? That always arrives too late.